as Marty said, 10 minutes each. We have 5 speakers. It's a super talented group. So I'm not going to spend a lot on the preamble, but one of the things I would say is we'll have a Q&A at the end, but if anybody has any pressing question that's important to the conversation, you can interrupt briefly. Myself, I run an investment firm called Income Growth Advisors, and I actually was talking about a gold strategy recently, which in light of Silicon Valley Bank really looks very timely from my perspective. I also am the president of a startup called Optima Process Systems, where we look at process technologies in the energy space with the idea of creating impact. The issue is ESG is evolving. We're moving away from, I'm getting a lot of background noise. We're getting away from the greenwashing, and there have been a lot of problems in terms of energy policy. We've seen that in Europe, and there are just huge opportunities. I think in chaos there's opportunity. This is a great example. And what I'm going to do is quickly say who's going to speak, and then have them. I'll make a quick intro for each of them. But we have Jennifer Warren, who is going to talk about SARA, which I believe is Cambridge Energy Research Association Energy Conference. She was there last week. And she's also going to talk about this huge legislation, the Inflation Reduction Act. Jennifer is an academic. She writes and understands the oil and gas industry well, but she's also very involved in new technologies in terms of energy. We have Michael, I don't know, Poisson. I want to say Poisson. You should be in Ohio or something, but anyway, he wrote a book, and this is really very interesting, called the ESG Data Revolution. And obviously, as we try to identify growing, promising sectors, having real credible data, Michael will be our second speaker and talk about what he's written and how what he has done can help us in terms of targeting promising growth areas. Next, we will have Bate, and he runs a company called PE Valuations. And he's going to talk about governance. And I was telling him earlier today, that's kind of funny. Back in November, I made an introduction. I said, well, we all know about governance and how important it is, because it was the immediate aftermath of FTX. Well, now it's the immediate aftermath of Silicon Valley Bank and the importance of governance. People think about ESG. We all know what E is. S and G are a little less clear, but Bate has great experience in terms of having worked at Schlumberger, Helix Energy Solutions, Halliburton, and he will be followed by Victor Sauers of TKO Energy. And last time we had a panel, we had a super athlete that we could talk a little bit about. TKO, I said, TKO, that's technical knockout. And lo and behold, he has some background in kickboxing. And so my suggestion, since after this, I guess everyone's going to go to the bar, don't anyone get any beer muscles, and you might regret it. But he has a PhD and a law degree, and is very focused in terms of impact solutions, and we'll talk about those. And then we will end with Don Turner. And Don Turner has a very interesting hydrogen energy group. He is the COO of that. He has a process to generate green hydrogen. I believe it's 5 nines, meaning very pure and efficient. And the price point is quite attractive. And he is trying to link that to hydrogen highways so that the hydrogen they produce can be then used to fuel hydrogen driven cars or trucks. So without any more ado, I'm going to try to time everyone at 10 minutes. But Jennifer, please tell us about Sarah and the IRA and a little about your background if I glossed over it.
Yeah. So just quickly, I'm a communications consultancy called Concept Elemental, with an emphasis on energy resources and sustainability, which includes capital sustainability. My themes for the year have sort of been capital efficiency, resource efficiency, which means sustainability basically. But and I come from a background of having chronicled both shale booms since they began, and so my version of ESG is a little bit like Lord of the Rings energy. But Sarah, jumping to Sarah. So yes, I was at Sarah last week, and Sarah, for anybody that doesn't know it, is pretty much one of the most important global energy gatherings in the world every year. Everybody from around the world, OPEC, all the majors, CEOs, everybody. The agenda was 104 pages. Big conference. And I'll just hit some of the takeaways because I think that'll be most relevant of the takeaways I participated in, because like I said, it was a vast topics and lots of people. But what I can say that I think is of interest is that there's the expectation that there will be a tight market in oil the second half of the year that has to do with supply fundamentals. Again, producers are all pumping, as they can, and then there are constraints to do with, underinvestment.
I'm up there.
Overhang, and
Sorry.
And underinvestment, overhang, and inflation, supply chains, and then we have interest rate rises, which also plays into projects. So we're kind of entering a new period in the oil market, and it can also be, it was characterized as being cloudy. And that was from a group that is quite august in their viewpoints of this. The other thing that was interesting was, and this is sort of a backroom thing, is that US shale is very much being recognized for its role on the global, stage. We have gone, in 2010, we were pumping roughly 2 million. Now it's 12. That's a very short period of time. That says a lot about our industry. Russia's loss in production has sort of been our gain. Like there's been like a 1 million barrel a day reduction by Russia, and we've sort of picked that up, that slack. And Russia said, or OPEC says they're really not concerned about how Russia's flows have changed, i.e. not to Europe, because with oil, flows are flows, and the oil is going to flow where the oil will flow. And a lot of it's flowing to India, Russia's production. The China situation that people are talking about, and this is just new news, this has nothing to do with Sarah. Just noting China is OPEC's biggest customer, so it makes sense that they would be, doing what they can to, protect their interests. Gas. Global natural gas map has changed with Russia. I've been talking about that since October. I've been monitoring all this since the Russian invasion happened, and even before, and I have a YouTube channel, and all my research is on it. All the interviews from all the work I've done is on it. My whole thesis that I've been advancing in research is all on my videos. But what's interesting about gas and LNG is that the US is picking up a lot of that LNG trade. Like 50% of it we're taking. Qatar is taking the other part. Let's see, and that goes up to 2030 roughly. There are some constraints. Everybody's excited about all the LNG and the potential on the Gulf Coast where it's going to happen. But there are constraints with facilities, which ones will be built. There are more pipelines needed. There are logistics issues. So pick your player carefully, use discernment, and look at their balance sheet, as we've now learned. So the Gulf Coast is going, and now I'm pivoting to the IRA, Tyson. The Gulf Coast is really the seat of US exports, and the IRA gives tailwinds to all the new technologies that are going to be used to reduce carbon emissions, the new hydrogen monies. I think there's about 24 billion for hydrogen and 10 for infrastructure, the hubs. The rest is tax credits. CCS, carbon capture and storage, 3.2 billion in tax credits, 11 billion for infrastructure. Nuclear in the IRA, 30 billion. Wind, solar storage, 128 billion. So the renewables got the lion's share of the IRA monies, just FYI. But big oil is very much participating in it. They're spending roughly 6% of their CapEx on low carbon ventures. That's going to continue. They're going to be big beneficiaries of the IRA, as are smaller firms that will be partnering with big oil. Let's see if there's anything else. I think I will probably stop there, but there's a lot of sustainable models that are going to be created from this. And I think the IRA gives tailwinds to all of these new developments. And you just have to be discerning about the players and their strategies.
Thank you, Jennifer. That's great. Are there any quick questions, or should we move on to Michael Poisson? Michael, tell us about your new book and how it can help us make some money.
Thanks, Tyson, and thanks, Marty, for inviting me. Now, clearly, I just was invited on Friday. This must be the most important topic over 2 days because you've got 6 people talking about it. But before I talk about the little book that I put together, I'll talk about my day job. I've been in the ESG research and data business with a company called IdealRatings for the last 10 years. IdealRatings didn't even start in the ESG space. We started in more of the responsible investing space. In fact, our very first clients were investors in the Middle East who needed to comply with Sharia laws, and so no guns, alcohol, tobacco. And as we started marketing our research and data to support those investors, people popped up and said, you're not very far from more other responsible investing and ESG and things like that. So today we're kind of a full-blown ESG data company. With ratings, I say, is regrettable in the name because it's odd that there's only a handful of credit rating agencies out there, but there are droves of ESG rating agencies out there. There's over 150 ESG research and data companies out there. Now, albeit some of them specialize in equality and some of them specialize in carbon, but still the fact is there's over 100 ESG data companies out there. Now, I'm not an expert in ESG. I'm not an expert in sustainability, but I'm an expert observer in marketing this research and data for the past 7 to 10 years. I'm just amazed by the number of companies that are emerging, the businesses that are emerging, and transitioning to this little book. I think they call it a short informational book, as opposed to a full-blown big book. If you want a copy, let me know. Where you can go to the esgdatarevolution.com or Amazon. But these are just my observations in the industry about the businesses, and talk about where's the capital flow, where's the investing opportunities. It's the emergence of new business in the space. Now, it did start with these 150 or so research and data companies, and once you have research and data, you can come up with some kind of a benchmark or rating. And that's what's happened. So you've got big names like MSCI, you've got funky names like Sustainalytics, you've got IdealRatings, my company, all doing research and data and some type of scoring. Once you have a means to score companies, then you come up with financial products, indexes, ETFs, and now we have a whole score of financial products out there, not limited to investments in funds that only invest in ESG investments. So whether that's private companies with ESG solutions or private companies that are, again, providing data and things like that. So what I tried to do, and more to make sense for myself in the book, was just talk about the origins of what is ESG, what is ESG data, where does it come from. A lot of the stuff now is being derived because the regulators have gotten involved and all the data doesn't exist. It's an interesting industry that is a result of a lot of unintended consequences. So what I mean by that is, I say a bold statement. Donald Trump has done more for the environment than any other world leader. Pause. Why? He backs out of the Paris Accord, and every CEO in the world says, we don't care what that guy said. We're doubling down on the environment and trying to distance themselves, but actually doing a bit more to commit to things like the environment. Other unintended consequences. Last year, a friend of mine who does research for ETFs, I couldn't get 2 minutes of his time to talk about ESG 3 years ago. He wrote a great article last year about using ESG to harvest tax losses. Huh? Well, we had so much in losses in equities last year that his advice was go and take that S&P index that you have, sell it, reinvest in the ESG equivalent, avoid the wash sale, and then all of a sudden you're back into the same investment and you've got all these losses to harvest for tax season. Fantastic. Now, all of a sudden, now we're going to see some correlations in ESG performance in financial products and totally unintended. People trying to get a tax break and they're actually investing and promoting and propping up ESG. So and then there are other kind of unintended consequences in the industry, which I think are phenomenal. We don't, for people that are kind of pro ESG, I consider myself pro ESG, but I'm redefining myself as ESG moderate, because I can't commit one way or another. And when they printed this book, it's not on recycled paper, so I can't be full-blown ESG. At least I'll be, ESG moderate for now. What that means to me is that at least you can acknowledge that there's climate change. You can acknowledge that things are wrong. You can acknowledge that we didn't need to make a change. I'm not out there again spending all my days and nights promoting how to make it a greener planet. It's just more of awareness, which started with my children, then with my career, and then ending in this book and kind invitations like this.
Do we know the size of the tax breaks that are expected from what you're talking about?
Again, it's people are just they're taking equities are down 60%. They're cashing in, they're taking that big chunk of loss, whatever size that means to them, and they're taking the tax advantage of that loss while reinvesting into the S&P equivalent of, or the ESG equivalent of the same product, which is different enough to avoid the wash sale rule. And again, it'd be a great analysis to quantify that. And who knows how many people are taking advantage of it. I don't know, but I just find it very interesting that somebody who wouldn't give me the ESG time of day is now writing great articles about how to use ESG. And then, by the way, for other purposes. Again, people with a strong ESG bias don't care as long as it's moving the effort in the right direction. I look at all the headlines, especially this year, Florida, Texas, putting a kibosh on putting an ESG lens on any kind of pension fund investing. And I think this is phenomenal. I think it's great. Headlines, anti-ESG movement. I've been going to these conferences for 10 years now. And these conferences have like-minded people listening to topics that they all agree on. We end the conference with a group hug and then we go to the next conference. I really want to see the battle royale. I want to see this anti-ESG person, this politician who's saying that you should not invest in ESG. In fact, we should make it unlawful to invest in ESG. I want to see this open debate on stage. And we're going to find more people paying for that conference to see that debate. Now, very unpopular statement, but if I boil it down to what that debate's going to look like, I've been a registered Republican, voting Republican my entire life, but probably with a left-green heart.
In New York City?
Massachusetts, New York.
Wow, that's kind of definition of futility.
Crazy. But that's, question my own identity. But, I just want to boil it down to, okay, we now have this debate on the stage, and you have these, I guess, right-leaning Republican people who've got certain morals and values that are saying no ESG, no ESG, no ESG. And I just want to ask, so if the best performing stock out there was the abortion drug and or an electric car, and one's performing okay, the other one's a blockbuster pharmaceutical, you're telling me you'd rather kill babies than build an electric car. I just want to hear that debate. Again, I throw it out there to be unpopular, but I just wanted to see this debate unfold on stage because it's raising more awareness to it. Again, I'm not going to pick sides. I'm an ESG moderator, but I think that the business opportunities now, so I think the ESG investment opportunity might not be any of those.
Okay, that's why we're asking you.
So what I'm looking at right now is compliance. Because regulation that's been threatened for over 5 years is finally, hitting the road in Europe, and US will shortly follow. But people that are coming up with audit assurance, compliance, and to fulfill a regulatory need, I think that's where some good investment is right now. I also think that we're going to have an influx of reluctant ESG brains. I call it, massive parallel processing for the field, because all these people that do not care to even mention the letters E, S, and G are going to be required to play because of compliance and regulatory reporting. So now we have 1 million additional brains thinking about it, and they're going to redefine the field and tell us what's really important. Again, these are the reluctant participants that are forced to play as a result of regulation, which everybody loves regulation, but in this particular case, I think ESG can benefit from regulation, at least for the short term.
Thank you. Let's move now to Bate, who is going to make the sometimes dry subject of governance very exciting. Go ahead, Bate.
Thank you, Tyson. Good afternoon, everyone. It's great to be here again. So my name is Bate, and I'm the managing partner at EP Valuation. Now, we're located in Houston and Dallas, with our clients and the projects they fund all over the United States. The company performs technical due diligence, asset valuations, and ESG reviews for banks and investors in the energy space. And we see the work we do as geared towards empowering our clients to make effective lending and investment decisions in what is increasingly challenging energy and financial landscape. Now, my specific background, or first I'll say in the past 2 years, post-COVID, within the energy industry, oil and gas specifically, we've done probably 100 valuations a year on deals from 25 million to about 5 billion in transaction value. Of those deals, we've noticed that companies have about 85% of companies have an ESG disclosure slide in their presentations, which is up from just about 10% in 2010. Right. So to your point, there's an increase in ESG disclosure, an increase in transparency towards ESG and in thinking about ESG. Now, whether or not there's an increase in compliance, that's still on the road. I would say we're doing a better job, but we're certainly not there yet in full compliance. Now, my specific background is I'm a professional engineer. I have a bachelor's in engineering from Montana Tech and an MBA from UT Dallas. I started out in the field working for Schlumberger, then Remington Oil and Gas. And after grad school, I was part of the core team that built Remington and sold it to Helix for 1.4 billion in 2006. Soon after that, I came over to the bank side. And interestingly, I joined Union Bank in September of 2008, a week after Lehman collapsed. So this week has had a very deja vu-ish feeling for me. And I'll get to that a little bit later. But after a few years at Union Bank, I did a stint in investment banking and then went to ING's energy division. As part of that technical group, I was head of the technical services. We valued $4 billion worth of commitments to the energy space. Having said that, turning to ESG, as I mentioned, based on the deals we have seen specifically this past 2 years, 85% of companies now have an ESG disclosure. However, the challenges, I think you alluded to them, are verification and follow-through. Companies self-disclose. It's difficult to know exactly how accurate those are, and our clients hire my firm to do some verification, dig through the company's operations and then make recommendations from an ESG perspective. When we look at companies, we have a three-pronged approach, if you would. The first is profitability. That seems obvious enough. Because the question simply is, will these companies survive through multiple commodity price cycles? If their setup and structure is such that they won't, then ESG is not going to be a priority for them, right? They just will make those commitments. The second is to have a well-defined and funded plan to decommission project sites. And if they don't, we would recommend that our clients include this in the request for funding or investment decision. And the third, which is increasingly gaining traction, is we encourage our clients to provide discount pricing to the companies they fund or invest in. And here's what I mean by that. When you buy a house, you have the option of sending that paperwork to escrow, your mortgage, insurance, and taxes. And most lenders will give you a few bips off your rate, maybe 10, maybe up to 25 bips if you do. We've noticed and feel strongly that oil and gas and energy clients should be so incentivized. If they set targets and they're able to pay for, measure those targets, and meet those targets, they should get a discount in pricing. Because we feel that ESG should not just be a cost. It should be an associated benefit at the end of that path, or along that path to compliance. So that's how we look at ESG. Now, I was going to be in Austin today. I am not, because Friday happened and Silicon Valley Bank went under. But more important, Saturday happened, and my phone just was buzzing off the hook, because I'm part of a group of founders and entrepreneurs in small companies, right? We're not big million-dollar companies, but we have enough cash that we worry about what's happening to that cash. And so I get texts, and I was in 3 different Twitter spaces. One of them, Mark Cuban, was speaking on Saturday morning about the Silverbank debacle. I bring this up because it became clear through this conversation on Twitter, on this live calls on Twitter, that a lot of companies like my own are not aware of Treasury Direct, for example, that instead of leaving your cash at Wells Fargo or your credit union above 250, that you could park it in short-term Treasury bills, right, and earn 4% on that. And it's still just as safe and easy to access. Because what happens is that small companies, and this was also the Silverbank problem, have very few people in management, right? You look at Silverbank statistics, most of the startups they funded had 2 or 3 founders in management, right? That was it. That doesn't give you a whole lot of room to have treasury management. There's nobody who's dedicated to treasury management. There's nobody who's dedicated to ensuring that governance policies are in place and followed. What that really means is that you open an account, you park cash in that account, you set up ADP payroll if you use ADP or whatever payroll you use, you set up direct payments with credit cards and all that, and you go to sleep, because that's really not your business. Focusing on the product you're trying to develop, you focus on trying to build a clientele. You never think about treasury management. You don't think about opening multiple accounts and having multiple relationships with different lenders, because you're just not at that stage yet. So I spent the weekend helping friends and other industry colleagues walking through some of that. How do we move money quickly through Treasury Direct? And I spent most of yesterday online advising people through it. And most of you probably already know this. It's about a 5 to 10 minute process. It's not that difficult. But most founders either don't know about it or don't really think about it. But true to the government, That website crashed at 11 o'clock yesterday. 11 a.m., I'm online working with a colleague, and the website crashed. I was offline till about 4 p.m. So that talks about scalability, right? For some reason, the government is never able to scale up when you really need it. Now, what does that have to do with governance? Silverbank was a seasoned company. There was nothing. Silicon Valley Bank was a seasoned company, right? Most of those guys had worked at other ventures. They had years in industry. But what has become clear, of course, is that, and they had a very large ESG focus. What has become clear is that you have to think past just ESG disclosures, carbon credits or carbon emissions. The governance aspect of ESG, the soundness of the company's internal policies, the company's compliance with its regulatory environment, those are all part of this ESG lens. And what we should think about from this perspective is, if I'm going to invest in a company, I need to know if the company understands its regulatory environment and if it's keeping up with changes in that environment. I need to know if the company is managing its risk well. That is material information for an investor to have. Right? So disclosures, and there's this bill running through Congress right now on ESG, should include material disclosures on companies' risk and governance. I want to know if the board of the company, a group of friends from college. There's nothing wrong with that. A lot of oil and gas companies get started that way. But you cannot run a big company just with your 5 buddies from college, right? You need diversity of thought in that process. I want to know, as Marty alluded to, that the company hires from a variety of pipelines, not just a few Ivy League schools, but that there's a variety of pipeline options for this company to hire from. And on a personal example, when I was at ING, we worked really hard to try to get diverse talent into the bank. It was difficult because ING had established relationships with specific recruiting shops, and they had relationships with specific schools. So if you wanted to change your talent pool, you have to change your ecosystem of recruiting partners, not just one school, but the entire system needs to change because they're very set. Right? So the governance aspect becomes a material disclosure requirement, or should become, because an investor needs to know if this company's management has the requisite experience to deal with impending climate change. If you own properties, say in Miami, and multifamily properties and apartments, well, your ability to make a profit very much depends on weather patterns. If you have offshore operations in the Gulf of Mexico, your ability to make a profit depends on weather patterns. What I believe in climate change or not is largely irrelevant. That management understands how it's probably impacted by storms in the Gulf, or by weather in Miami, or hurricanes in Houston. That is important. And that should be part of the disclosures that I hope this regulation includes. So I'll pause there, and maybe we can have a conversation about the importance of management's role in understanding governance requirements, its regulatory requirements, and ensuring that its investors are aware of the experience and the focus they have, if any, on managing these risks to their business.
Thank you, Bate. I'd like to move next to Victor Sauers of TKO Energy. And
Tyson, I had a couple of questions in the chat, Tyson.
I'm sorry, what?
I had a couple of questions in the chat.
All right.
And musical chairs. Yeah, so the questions were, what is the 1,500, what does the fact that 1,500 ESG firms had their bank accounts in Silicon Valley Bank, what's the impact of that on the industry? There's someone here. Any thoughts or?
Yes. The impact of that, I think, at least over the weekend, was the minor disruption of, are we going to make payroll, and our clients, our employees going to get paid, and what is the kind of the social social impact for our business that we're associated with the failing bank. I think fundamentally, though, most of these companies need to do, as I mentioned before, need to do better in diversifying relationships with banks and other institutions, right? Not just have everything at one place. I would say that Silicon Valley Bank, I believe from one of the stats I've looked at, was funded or was part of funding nearly 60% of early stage companies in the renewable space. That is a material gap, right? And I don't believe there's any institution right now that can take that on. And so you will see much fewer new companies being formed in the tech space because of that. But perhaps more important, you will see valuations drop because of it. I think perhaps that's an important aspect of it. Valuation.
So yesterday we kind of concluded that there's a staffing issue with many of these companies in terms of, not having the correct chief financial officers who should know how to deal with banking, right? I mean, any thoughts, or does the panel here have any thoughts on that? Or?
So going Roku had one bank account at Silicon Valley Bank, one for 400 million, right? So that CFO needs to go, 100%, right? As simple as that. It's due diligence through and through, and it goes to the governance conversation we'll have here momentarily. But if you kind of look at that, where the question, what's the effect of the 1,500 startup companies? Guess what? If you're coming in for financing and there's one account or even two accounts, and you can foresee this because you know for a fact that for you being a startup company for last year in 2022, it was much more difficult for you to get money, number one. Number two, you know that yet inflation was coming up. And number three, you're going to have a situation where you should know your bank. So it's not just Silicon Valley leadership, but as well as a startup company, especially if you're making revenue. Ruku's over a couple billion. One bank account. So if you're coming to me for money, it's going to be a long time. So this damage is more than, yes, we have Treasury covering all debt, all deposits, all of them. So that means how is the Treasury going to cover 9 trillion deposits in the US if it's a freebie? If I have a private bank that you're going to cover billions of dollars, right? And I have another bank. I have a bank that was playing crypto. Number 2 bank went down. You shouldn't have done that. So the governance is damaging to their members. And there should be a degree of governance to say, hey, you know what? You shouldn't have all your money in one account in our bank. You really shouldn't do that.
And I think Rob's going to discuss that later, because I think the issue is I can't imagine any bank would allow the stipulation that they give you a loan for a venture debt. That's going to be allowed to happen again, where this massive amounts of deposits will be mandated to be.
We'll see what Treasury says. Right now, the business situation where it's allowing the leadership to be lax, and there's a safety net for them to do due diligence to either shareholders or their members right now. It's terrible.
Well, there's also this element of moral hazard, right? I mean, so higher interest rates, we've seen this shift. We've talked about this, Tyson, shift with the triple Q versus XLE, the value versus tech, swap that happened, during the pandemic, after the pandemic, this big shakeout that's happening, which is an element of creative destruction, the old making way for the new. You have moral hazard, you have creative destruction going on, and, and interest rates are rising, projects, capital costs more. You have to have a higher threshold for everything, leadership, money management, product, ideas, your story better make sense to the market, because the market is smartened up, and that's being revealed, I think. It's revealed in the energy markets, it's revealed that in oil and gas, it's 80% of primary demand in Ukraine, Russia, the Russian invasion revealed that, so we just have all these things, coming to light to make us really be discerning, be more discerning in this. All I can say.
Let's move over to.
So let's go and move to Victor Sauers and tell us about TKO Energy Capital and some of the projects that we discussed or that you're working on that really kind of advance the impact, but also have economic logic behind them that you like, and it'd be great if you share that with us.
Thank you, Tyson. It's good to see you again via Zoom. And Marty, thank you for inviting me. So yes, I'm the CEO of TKO Energy Capital. We do the industrial level high energy asset classes. So data centers, oil and gas, semiconductor, transmission, generation, what have you. So what we do is that if we look at an asset, work upon a asset that we're partnering with, we say, how do we add energy technology that make it more revenue efficient, which means less emissions as well. We've been doing this long before the concept of ESG was even thought about. It's really fundamental discipline that we look at it. It'd be fundamental discipline if you're going to be impacting the environment, you're going to threaten my asset. If you are doing excessive emissions, well, you know what? That means you're not revenue efficient, and you're going to threaten my asset. If you're looking at my asset, these are industrial assets, so they're long-term plays that you don't have the sustainability. Doesn't matter if it's EV vehicles or renewables, what have you. If you haven't looked at the logistics and the various costs and what the reality is, you're threatening my asset. On governance, if you're not looking at the fundamental governance and you're not paying attention as a board of how things are being allocated, if your ship is straight to make the members aware and investors aware of hiccups coming down the road, you're not doing governance. So yes, we can add additional words for ESG. That is that losing the focus of the fundamentals that we should be doing from day one. And I believe that's the case in some areas. We're losing focus and allowing leadership to be a little bit lax, which can cost me money. Not enjoying that. So we look at it going forward. We're a big fan of renewables because we're also regulatory. We spent a lot of effort with my team at the regulatory level. We wanted renewables in Texas. We focused on wind in the 90s. We did not want to upset the large utilities, so we said the lowest fuel cost gets on the grid first. Well, what's the fuel cost of solar and wind? Zero. So the other thing we looked at was energy storage. So we promoted energy storage to get the regulatory stuff through. That it was accepted as the Texas PUC, and that was done. So as we look at things, where do we need to work on the regulatory side to fit our goals for sustainability and security on those assets to have a great return? Because ultimately, I'm responsible for other people's money. And so I have to say, you know what, it's just something where we're going to get in trouble. So in that sense, we're doing really good in the sense that since Marty's had us here in Texas, I just looked up Texas by June. We need that guy. 58 gigawatts. What's a gigawatt? Gigawatt is 200,000 homes. Texas is going to have 58 gigawatt of renewables on the grid by this June. And I looked at how much renewables generation is in Texas. And this afternoon, it's going to be 23 gigawatt. That's 23 nuclear power stations running that are renewable, emissions free, between wind and solar. At the same token, I looked at California, same time frame. And they're going to do 6.6 gigawatt of renewables. Texas is doing 23, they're doing 4x. At the same token, I looked at California grid total load for the day, everything, the whole state. It's 25 gigawatt for everything. Texas is generating almost as much as California is consuming renewables only. Give you an idea. The other thing I looked at was what is the spot market pricing for a megawatt of power at the wholesale level? When I looked at it for ERCOT in Texas, it was $14 for a megawatt. Same time frame in California was $80, right? So decisions that we do, adding technology on an industrial asset class, It says, you know what, I need to make power affordable. If I focus on that in my role, it also affects ratepayers who are on a fixed income, grandma, grandpa, right? People on fixed income. We do the PUC, not just Texas, but throughout the country, other public utility commissions, where that's concerned, where the ratepayer lobbyist is the most powerful group. Because it's votes. If you have 500,000 members, you better listen to what they have to say, because they might not understand renewables or energy storage, right? But we also do oil and gas. If we see oil and gas, you know, you guys run typically oil and gas typically runs from an energy component, highly inefficient. So we look at it, do you have to flare? All right, well, let's do a microgrid and burn fuel if we can't get a wire. If we can get a wire and we're flaring terribly, well, let's push power the other way. Because we're having a big problem with renewables where we have the Inflation Reduction Act, where the line share, Jennifer is correct, is mostly for renewables. But guess what? I have 1.6 terawatt of backlog renewables. Now, what is a terawatt for our listening members? Well, if you're talking about a megawatt, a gigawatt is 1,000 times bigger. If you talk about a terawatt, it's 1,000 times bigger than a gigawatt. So that's 1,600 renewable projects that are standing by to do nothing because they can't get interconnection to the grid. Now, here's the deal on this. The Inflation Reduction Act has $0 for grid. In other words, water. So if you look at it where I'm buying a bunch of cars that go on a single lane highway, well, guess what? It's crowded, it's congested. I can't put any more cars on the highway. You're done unless you build more road. In this particular case, you need to build more wire. So what do? I want to place assets. I want to look at enhancement as well. So we are talking to oil and gas guys. That's an intensive electrical load for assets, oil and gas assets that use electricity for the lifting capability, not gas lift. So we said, you know what, you guys are so big in this area, in this field, that you control that substation and other substations. I said, why don't you guys start doing renewables? Because you're really good landmen, right? You own the surface rights. Go put wind or solar in West Texas. Because otherwise there's no interconnection. 5 megawatt here, 10 megawatt in here, right? Stay below the 10 megawatts so you can stay up, you don't have to become a utility, right? But if you look at Shell, a couple of years ago, they bought what they call an REP. It's a retail energy provider, and they provide power contracts from retail, commercial, and industrial. And Shell wanted to get into the energy space, the electron space, at a utility scale, but they didn't want to make mistakes that BP did. BP tried to become an OEM and renewables, and it was a crash and burn. So what do? I need to understand how this market works. And they did. So now they are investing in renewable at utility scale. And they're providing contracts to retail, wholesale, all the way up to industrial. They're learning the business. And on the side, you have Exxon looking what Shell's doing and say, okay, well, they're adding another revenue segment within their industry, right? Even Diamondback is looking at it. Anybody who has this huge amount of land mass for solar, for wind, right? Well, because we're drillers, we're oil and gas, right? And we use this enormous amount of power and we have the infrastructure. That's what we can put renewables, start pushing back, right? Push electrons the other way. Don't be a consumer, be a generator, right? The other thing we did, we worked with utilities, is this thing called LARS, which is load as a service, and at the time, you had to be a 10 megawatt load, a large industrial load, to play ball with the grid, like ERCOT. So we brought that down to 25 kW. Somebody commercial can play ball, and you can aggregate it. So if I have a bunch of assets all over the place in Texas, I can bid in all those assets with one bid, right? That's great. So you make money that way as part of a smart grid kind of thing. So that's how we look at it, is that if I'm going to do an investment, I'm going to look at transmission, and then I'm going to say with my oil and gas assets, going, you know what, let's look at adding another revenue stream. Relative to sustainability on renewables, I'm concerned about items that are used in EV vehicles, which is electrical grade steel. Transformers is electrical grade steel. right? And also power electronics for energy storage, electrical grade steel. But there's only 3 countries to do that: China, Japan, and US. They're all 3, they're 2 years, 2.5 years backlog for steel, electrical grade steel, right? The thing about the automotive, both for lithium ion batteries and electrical grade steel, is they're willing to pay premium wholesale pricing, and utilities can't afford that. So that's another. So in other words, as we're trying to be a little more green, emissions free, well, you're getting to the point where you're not being sustainable. We work with 168 co-ops around the US. There's 900 utilities, over 900 utilities in the United States. Every single leader, from a GM to a president of a utility, electrical, said, you know what, no more renewables. Because my grid is unstable and I have to run my reserve. These are generators that are on standby. Now they're running them. Well, somebody has to pay for that fuel. So now people on fixed income, where they're paying 8 cents, now they're paying 9 to 10 cents, right?
So isn't there like a big question about putting all of these cars on the grid because of
Good point.
the vulnerability?
Yes.
Yeah,
of
let
our
me-
network? I mean, you have terrorist networks that are mapped
No,
out,
that's
you know, all of the
just-
charging stations.
So here's the deal with that. So the smaller co-ops, which are, we all know a co-op is a pass-through, they're not a profit center. But they're forced to put these charging stations, and these are level 3 charging stations at 350 kW, right? And they can't afford that spot market buy. Can you imagine I have, okay, here's a 10 spot charging station at 350 each, because you got an electrical vehicle and you want to charge up really quick and get going, right? Great. Well, here's the deal about that. Most of the conversation for the executives of utilities says, you know, as soon as you plug in at a level 3 charger and you hit 350, in other words, you have a max to charge, I'm going to charge you $350 because they can't afford it. If you have a level 1 charger in your home and you want to charge overnight for 10 hours, great, you're free and clear. But you go to a charging station that is put in and managed by utility, they're going to be forced to charge you at the kW rate. Instantaneously, not how much you need to charge a battery, that's kWh, right? At the kW rate, as soon as you hit that switch to charge.
Yeah, my question actually is that there's a vulnerability because people know where the relay stations are for electricity, and there's kind of a crisis going on in the United States right now. People shooting those up and causing blackouts. North Carolina, Florida, I know what's happening in Texas. It's happening in California. I mean, it's so odd and strange.
Well, that's why hybrids are the best energy
There you go,
security
there you go.
play.
Yeah.
You still want a tank. I talked about this like 3 videos ago. You know, tanks matter,
So we did evaluation on electric vehicles. So you have Prime, you have UPS, and they say, you know what, we're buying a fleet of electrical delivery vehicles, and I need 150 megawatt for my parking lot, right? At the same token, you look at the risk between, you know what, if you get 7 degrees like we had in Winter Storm Uri in the state of Texas, your battery's going to drop 50%. And most likely, you're not going to have available power because ERCOT's going to force you to shut down, and they did in Winter Storm Uri. And it happens all the time. You're asked, you get a phone call, hey, can you shut down your plant for a while, right? So hybrids, if I'm a risk manager and I'm buying tens of thousands of delivery vehicles, I'm going to say, you know what, do I want gas? Do I want electric? Or do I want a hybrid? And there is data back there by the Ford F-150 hybrid vehicle. That is awesome vehicle. It is awesome. It's just as powerful as the Lightning truck, right? So, but it de-risk. So it's all about de-risking and being fiduciary responsible on the ESG, environmental, emissions, is sustainable, and governance. I tell you what, out of the 5 companies that I have, I sold 3, I'm running 2 right now. 82% of my employees have their own company now. So that supercharges the person. We have diversity all over the place. But I want you working for me to have confidence that you never have to fill out an employment form again. If you don't wish to, I'll give you confidence to run your own company. You can do this. That's empowerment. So all my managers are focused on training our junior people to have confidence. And they say, you know what? You want my board members to say, you're risking losing talent. You give them too much confidence. The payback I get And the resource we get because of that relationship is tenfold.
No, future business partners, we need to move it on Don, because we're running short on time, so we can get Don in for the last segment, and then we're gonna move over to Rob Suffoletto and talk about.
So Don has a killer presentation on his company. He's the COO of Hydrogen Energy Group. Go ahead, Don.
Okay, great. Thank you very much. I appreciate you being on the panel, and again, Victor, great insight, stuff like that. That's a good segue to what I'm going to talk about. Again, I'm Chief Operating Officer of H2 Energy Group. We produce green hydrogen and net zero electricity. Few seconds on my background. I started off in automotive engineering, then aerospace. In the last 25 years has been high tech. Everything from high-end animation to artificial intelligence. And then a year and a half ago, I had to learn how to spell chemistry again, because I went into the energy space. My background is about a third international strategy work with Booz Allen and a few boutique firms. A third of it is corporate management, chief strategy officer of a $1 billion IPO and group president of a public telecom company. And then for the last 15 years, has been a serial CEO of a bunch of different companies, mostly in the technology space. So takeaways. One is that we need to, greenhouse gases are real. I've never really been a tree hugger, but as I look at more and more of the data, we do have an issue with greenhouse gases. We need to look at renewable and sustainable fuels. Number two is I would suggest to you that green hydrogen is a viable part of a future portfolio strategy for fuels. And we're going to talk about green hydrogen in a second. But bottom line, our company from an investment standpoint is we can produce green hydrogen cheaper than anybody else on the planet. That sounds like a hyperbolic statement, but we can back it up. So why is green hydrogen important? Why is hydrogen important? Well, from a pure investment standpoint, 2016, there were about $676 million of investment money in the US on hydrogen. Now they expect in 2027 for that to go up to 7.3 billion, 61% growth rate over those years. So everybody's interested. If you're in the energy space at all, it's kind of the buzzword du jour. Everybody's trying to understand hydrogen and its role. The problem is that today, 96% of all hydrogen is produced through steam methane reforming process that produces a lot of CO2, greenhouse gas emissions. So if you take a look at green hydrogen, about 5% of all hydrogen in the world is green. And almost all that today is made via electrolysis. You did it back in your high school laboratory. You took a current, you ran it through the water, and you saw the bubbling. Well, that was oxygen and hydrogen. And that's a great process. And but we don't do that. And most people are not familiar with what we do. We do pyrolysis. Most people are not aware that you can take any organic object. You can take trees, forest refuse, energy grass, municipal solid waste. And if you heat it up high enough, you gasify it into its constituents and it has a certain percentage of hydrogen. We take that and purify it and we make green hydrogen. So the input to our process is biomass. And one of our first projects is to transform I-5 interstate highway from Everett, Washington down to Carlsbad, California into a 1,250 mile long hydrogen highway. Why that and why California? Well, California, as we all know, has got the most stringent environmental laws, number one. Number two is they are really trying to get away from diesel 18-wheelers throwing CO2 in the air. Just to give you a little perspective, a typical 18-wheel diesel truck will put 8 pounds of CO2 in the air every mile. You take that and you run it out by how many miles they typically draw, and the fact there's 10,000 trucks on average on I-5 every day, with peaks up to 35,000. And on I-5 only, there's 7.3 million tons of CO2 being put in the air every year. So the big OEMs have looked at it and they realize that hydrogen is really the way to go. A few of them have looked at electric, but the problem with electric is it takes too long to charge. You're using a lot of the weight of the vehicle to handle the batteries. And truckers make money on time, and so we can go in and they're looking all at green hydrogen right now. So what we do right now, our status is we're relatively early stage, but we're making a lot of progress. We just finished a Reg CF for $5 million. We're now have a Reg D for $100 million. We have received a grant from the state of California to get our property in Red Bluff, California, which is equidistant between Everett and Carlsbad, shovel ready for our plant. Our plant will produce 10,000 kilograms of hydrogen a day. And then we've got 5 filling stations equidistant along that I-5 corridor. We're producing a green hydrogen. Our cost is less than $2, probably more around $1.50, and it's dropping every day as the progress we're making on our reactors. And our electricity is about 9 cents. So when we talk about sustainable renewables, we delineate those two terms. Renewable is you can use it over and over again. The source of energy is, and you know, as Victor said, wind and sun, the energy is essentially free. The challenge is we suggest that they're not really sustainable because the wind doesn't always blow and the sun doesn't always shine, and battery backup systems are expensive. We run 7x24x365, and we just keep feeding biomass into our reactors, and it produces a syngas. That syngas can either go into a genset, we produce our own electricity, or we purify it and we can get 5 nines hydrogen. So for example, in California, you talk about the grid, we are behind the meter. We tried to work with PG&E and tie into their grid and stuff like that, and we saw the prices for it. You know, again, we're producing electricity at less than 9 cents a kilowatt hour. We produce our own electricity. So we have a certain number of our reactors are creating gas that generates electricity. That electricity feeds the other reactors that are creating the green hydrogen, and then we purify that. And now we're looking at several opportunities in Europe where they're looking at microgrids where they want us really just for our electricity because they're having problems with consistency. And as you know, the prices for a kilowatt hour in Europe range from 40 cents to 90 cents a kilowatt hour.
There's only a few minutes left.
Okay, so that's where we are. So the takeaways with is we're green hydrogen, very inexpensive green hydrogen and net zero electricity. We've got a process that most people are not familiar with. It's proven. We have a top engineering company that confirmed our process. And so that's what we did. I'll stop there and see if there's any questions.
I was just gonna ask you, this is the IRA legislation. So how is that going to help with those hydrogen credits? Or
With the hydrogen credits, we have set our strategy for the company from day one to never be dependent on energy or on government monies.
yeah,
Because it's not consistent, you can't rely on it.
right,
With the IRA, we're actually producing at a negative cost. The government's paying us to make it.
right,
Because we're making it at $1.50 and there's $3 out there for us.
right.
Are you looking for financing for some of these infrastructure projects?
Yeah, we are. We separate each one. We've actually got 3 companies. They're all tied together. We have a hydrogen company, electric company, and then because the biomass is such a high percentage of our OpEx, we have a biomass company where we're actually working on several energy grasses that not only will grow 20 feet in 1 year, we get 25 tons out of every acre per year, but they also absorb over 13 tons of CO2. So we're getting carbon credits for the CO2 absorption of the energy grass. But yeah, we're looking for funding right now. Like I said, we have a Reg D going right now. We have a major bank that's agreed to underwrite us for up to 75 million. So we're just looking for some more equity to kick us off. But as I mentioned to you, the state of California has already given us some money to get our spot in Red Bluff, California, shovel ready. And by the way, I got to tell you, when I first went in to start dealing with the California, the utilities we don't have a good taste with, but all of their other organizations have been very helpful, very cooperative, trying to help us get going. And also, one of the things I should mention too is we're also working. One of our partners is Redding Rancheria, a native Indian tribal government in Redding, California.
So
So
Doug,
I tell everyone to make sure they put up their contact information before we end this session. Go ahead, Bate.
now I was just going to mention, I suppose maybe reach out to me. I think I have contacts at a couple of banks that would love to take a look at your product. I had a conversation yesterday with a guy in Dallas who's doing something similar. Funding, the reviewing of funding for something similar. So they understand that model. Reach out to me. I'm happy to make that connection and see if it takes you guys anywhere.
Yeah, we would love to talk to them. And I was talking to somebody the other day in Europe, and was saying, "What's the one thing I should know?" And I said, "Well, the one thing you should know is if I use sun or wind to make hydrogen via electrolysis, I'm looking at about $6 a kilogram. If I'm looking at the grid in California prices, I'm looking anywhere from 12 to 15. I says, we're $1.50. Do you need to know any more?"
So Dom, can I ask a question?
Absolutely.
So we're looking at a 650 megawatt hydrogen plant in Texas, and what's the feedstock? That's my concern. And is it sustainable?
Yes.
So they said, yeah, well, you got a contract for 2.8 cents million BTU. I said, okay, well, what fields is it coming from? Well, you get in trouble, right? So that's one part of it. The other part, and a better understanding from your biomass feedstock is because that seems to me that can be limited for scalability. If I'm doing either brackish water, I'm doing natural gas, what have you.
Yeah, good point. I'll have to talk to you more in detail about that, but the quick answer is, Texas, and I'm a new Texas native as of a year and a half ago. I got my driver's license, so I'm official. But Texas is really good, especially West Texas, because you get a lot of sun and there's not a lot of grid out there. Now, we have been approached by putting microgrids. We need access to biomass. Now, with our energy grass, it's pretty resilient. We're looking at buying 77,000 acres in the Northern Territory of Australia to grow our energy grass. And again, that produces 25 tons of 8,000 BTU per pound biosource. But we're not, just like sun and wind, we're not applicable to every situation. If there's no biomass around, we would not be like a good candidate in the Middle East. So we need to have biomass around. But we found out we can grow the biomass pretty quickly. And also there's 144 million dead down in diseased trees in California, and the state's burning down. We have an agreement now with a company that they're going to provide us biomass, pulling all that stuff out of there. Because with all due respect to the Sierra Club, if you try to light a green tree, it's really, really difficult. It's all the dead stuff, it's all the dying stuff that's down on the ground. If you get that out of there, the forests are not going to catch on fire.
Fantastic. Well, listen, that's great. Thanks so much, guys.